Hi, my name is Dominic Tamaro, and I'm the Vice Chair for Education at the Warren Alpert Medical School at Brown University. For over 30 years, I was the Internal Medicine Residency Director, and for many years, residents would come in and ask me for financial advice, and that really was the genesis of why we put this curriculum together.
Hi, my name is Pete Heckman. I'm a financial planner for physicians and have been for 20 years. I'm also the founder and managing partner of Residency to Retirement Wealth, which is a full-service planning firm for medical professionals.
My name is Chris Weber. I'm also one of the founders, managing partners for Archair Wealth or Residency Retirement Wealth. I've been a financial advisor working with physicians for about 20 years, and we are part of the GSI program that's here. We're the endorsed advisors for the GSI plan at Brown, and I live in New York, but we're here quite often.
Welcome, and thank you for visiting Brown's financial literacy curriculum. Today's focus in this brief video will be a discussion about life insurance. And I will turn it over to our experts in the area and let you guys take it from here.
Well, we spent a lot of time talking about disability insurance, and disability insurance is meant to replace your income if you're hurt or sick. Life insurance is meant to do the same thing, just under different circumstances, the circumstances of passing away prematurely. So for young trainees, residents, life insurance is accomplishing the same thing as disability, it's just doing it under different circumstances. So the way to look at life insurance that I recommend that they use, it's called human life value. Human life value is a calculation of what would someone be worth economically to their family had they worked for their entire career. So what they look at is someone's age, how much they'll be making, and they project that out over 30 years. And you can get a sense of how much income someone's going to be generating. And then you can use that as a basis to determine what amount of life insurance makes the most sense for you. We typically recommend for the trainees only term life insurance. It's straightforward. Term is what it sounds like. It's temporary coverage. You own it for a term or a period of years. You pick 10-year, 15-year, 20-year, 30. And you pick a death benefit that to some extent can replicate your income to your family. The simple math that I use when giving a client sort of the framework for deciding on how much to have is if you have $1 million of life insurance and you pass away and your spouse receives that $1 million, the proceeds are paid out tax-free, so they'd receive a lump sum of $1 million. If they came to Chris and I and they said, how do I replace my spouse's income with this $1 million? The typical mechanism by which people do that is they take that million and they invest it. They typically invest it conservatively because it's all that's economically left of their partner. So they typically don't get radical with the way where they're putting it. So they put it someplace conservative and say that can earn 4% interest. Nice, safe, high yield savings, something like that. That means that $1 million can shed $40,000 a year consistently to that family in lieu of the paychecks that the primary earner was earning before they passed away. So with that model in mind, you can imagine as an attending, obviously there's going to be a need for a lot more life insurance than $1 million, right? Because if we're trying to replicate income to the family the same way we're with disability insurance, you have to be mindful of that framework to do it. So it isn't uncommon that an attending will be carrying anywhere from $5 to $15 million of life insurance, such that they know that if they're no longer here, that interest payment that it will shed to the family is going to be approximately what their salary was. Residents and fellows have kind of a problem there because on paper, they're going to make a lot more than they're making now. Obviously, the income's going to radically change. So the insurance companies say, and simultaneously the insurance companies say, we're not going to overinsure somebody. Like right now, you're making $80,000 a year. We're not going to give you $15 million of life insurance. So the insurance companies all say, with few exceptions, but for the most part, they say that any trainee can have up to $3 million of life insurance. It's more than you should have based on your income, but it's less than you're going to need when you become an attending. So if someone has $3 million of life insurance and that same math of 4 or 5% interest, they know that their family could live on $120,000 to $150,000 a year in their, if they're no longer around. So that's really the way to think about life insurance. Beyond that, it's just a question of picking a company, picking a term of years that you're covered for. And unlike disability insurance, and this will be the last thing I mention on it, your pricing for life insurance is a function of your health. With disability insurance, it's typically the case that they say, hey, if you have a bad knee, we're not going to cover your knee, but you're probably going to pay about the same for someone who's in the same specialty, same age, same gender. It's going to be the same price point. With life insurance, when you apply, they put you into one of 15 different health categories. They either say you're impeccable, you're elite. You've got a cholesterol, you're preferred. You've got cholesterol and a history of this, you're a non-smoker, and it goes down to 15 different rungs. Whichever rung you land in affects the price per million of coverage. So it's with life insurance, it's really in your best interest if you need it to try to get coverage while you're as young and as ostensibly healthy as possible, because that will really meaningfully impact what the price is.
And life insurance, unlike disability insurance, it does take into account family health history. So that could be used negatively against you. You could say, I've never had any issues at all, I'm in perfect health, I've never even seen a doctor, but my father passed away early, my mother passed away early, and they'll want to know when you take that application, how did they pass away? Like what was the cause? And they could use that against you and say, oh, you're not getting the best rating or the second best rating because of your family health history, we're going to give you the third best rating. And that's very possible.
Are there, so that's a way to figure out how much I need. So it sounds like life insurance policies are all underwritten.
Yes.
Right, so meaning someone has evaluated your health history to assess the risk to the insurance company.
One thing that's interesting that just happened, this is brand new.
It's about a week ago, actually.
Started April 15th of this year. There is now at this institution, it's actually not in every state, but it's here, it's in this hospital. There is a GSI life insurance plan. It just happened. So it's up to $500,000, no medical underwriting, and a preferred rate, which is a great rate. And it basically means if you have a health history, if you have medical concerns, this could be an option for you. You could look at it, again, you want to look at all your options, but for a lot of people, this may be the best option. Some people may have not a great rating, they could look at this and they'll have at least $500,000 with an excellent rating. And the price is really inexpensive. I think for $500,000 of a death benefit, the cost is under $30 a month for a 30-year-old female.
Are there people that don't need life insurance?
Yeah, I think there are. I think when we talk to residents and we talk to fellows, they're on a really limited budget. So we'll talk to them and we'll say things. And it's always, these conversations are always difficult. They're morbid conversations. We're talking about death. But we'll say to them, are you married? Is there somebody out there that's dependent on your income? Is there a spouse that's dependent on you? Or a partner dependent on you? And if they say yes, life insurance is going to make sense. If we say to them, do you have children? Do you have family members that are dependent? And they may say yes, life insurance makes a lot of sense. Do you want to give money to a charity? There's something that's important. You're giving money every month somewhere. And they may say yes, life insurance makes sense. But sometimes we'll have somebody that will say, I'm a first-year resident. I mean, if I die, everybody's wearing black for a month. They're going to miss me, but nobody's dependent on my income. It's just me right now. I'm a little bit of an island right now when it comes to that world. Do I need life insurance? The answer is you probably don't need it. It's probably okay to not have it right now, because we have to look and see, you only have so much money every month. We have to figure out how can we do the best job possible, protect you in the right ways. And then eventually you may want life insurance, but it's going to be the top place in that hierarchy of what's important to you? Maybe not.
You made me think of that first-year resident that no one's dependent on his income. His student loans are probably dependent on his income. How do loans figure student debt? What happens to student debt when you die?
Well, typically federal student loans are forgiven at death. They're not forgiven at disability, but they are forgiven at death. So depending on someone's loans, it might not be the case that they need life insurance to backstop the loans. If someone has significant private debt, private student loans, maybe they own a home, they have a mortgage, there are instances where the life insurance is more relevant, even if they are sort of an island.
That's very true. That's a good point.
Yeah. Well, we have seen a lot of residents over the years say, oh my God, I've got $1 million in student loan debt, I need $1 million of life insurance, but they're all federal loans that are going to be forgiven at death. So,
yeah, if they move to that private company and they refinance, it's a different story. You may not need that life insurance.